you are looking live at Belmont University in Nashville, Tennessee, where in just a few hours' time, President Trump and former Vice President Joe Biden will square off in their final debate before the election. And with just 12 days to go, we are starting to hear from some big market players and how they are positioned heading into the vote. Here's what Paul Tudor Jones said earlier today on Squawk Box.
The election's obviously a really big deal, has huge impact on the markets. I think there's so many things around it that I think there's a lot of false narratives around what will happen in the election in terms of the impact that it's going to have on markets. And it's going to be really interesting to see it play out over the coming months.
We also heard from legendary investor Boaz Weinstein. He is ringing the alarm about the big disconnect that he sees between credit spreads and volatility heading into the election. Volatility being high, credit spreads being relatively tame. So what does this mean for your money? Let's bring in Chris White, the CEO of BondClick. Chris, great to see you again.
Great to be back, Melissa. Thanks for having me.
Why do you think the credit markets are not pricing in the volatility that the equity markets see?
Because this is exactly what the Fed designed. It's interesting that in Boaz's statements, he was talking about the disconnect in terms of the historical relationship between the VIX and credit markets occurring in August. That's what you would expect when the Fed starts actually buying corporate bonds in the secondary market in June. So it took a little while, but this is just a natural reaction to there being a buyer in the market that has a blank checkbook.
In his statement, he also said, this is his quote, because I do want to, he acknowledges that the Fed has been holding this market up and the impact of the Fed being in the market. But he says if a second wave of infections is even worse than people think, if we have a contested election or even ways that are unknowns, a chance for a very significant move is there. Do you think that the Fed will be in that market to stabilize the market if any of those scenarios come to fruition?
From everything the Fed's been saying and everything the Fed's been doing, they absolutely will be there. The Fed is looking at the corporate bond market as really being at the heart of the U.S. economy right now, and to keep unemployment rates low, you've got to keep allowing companies the ability to borrow and borrow cheaply. So the Fed has a lot more bullets in their gun. At this point in time, Melissa, the Fed's only spent about $4.5 billion, and clearly they have a lot more ammunition that they can commit to keeping the corporate bond market, functioning from a liquidity standpoint and from just an overall value standpoint.
It's Karen. Thanks for being on. I had a slightly different number, but the point was the same, that the Fed hasn't used very many bullets so far. Do you think if things got rocky, they would step in before they really got bad, or would they wait a little to see how bad it would get?
I think that what's really happened to credit markets right now is indicative in your question, where we're not even talking about the fundamentals of underlying companies. We're talking about what the Fed's going to do. And that's really what people have been trading for quite some time right now. It's really difficult to predict what they will do. But from what they've done in the past, every time there's been just a slight hiccup in the market, the Fed starts charging in. And now that they're fully invested in the U.S. secondary corporate bond market, I can just see them continuing to buy bonds the same way the Bank of Japan has continued to buy corporate bonds, and the same way the ECB has continued to buy corporate bonds for years. So while I absolutely respect what Boaz Weinstein's saying, I think it's very dangerous to play a game of trying to time when credit markets are going to unwind when you have an entity like this doing something that has no historical precedent.
So it sounds, Chris, like you're saying that there is a disconnect between the fundamentals that would typically drive a bond trade and what the bonds are trading at. So bonds are therefore no longer a good clue to investors on the financial health of a company or a sector.
Absolutely. I mean, look, a lot of people have made really good money this year being long the corporate bond market, especially if you were a big buyer in March when corporate bonds sold off. But as soon as the Fed said that they would step into the market, we saw the market coming back. And that was without the Fed even spending a dime. There's an old saying in the market can remain irrational longer than you can remain solvent. I think the upgrade here is the Fed can remain solvent longer than you can remain solvent. So if you're going to try an investing strategy in which you're waiting for the Fed to quit, that sounds pretty risky to me.
Hey, Chris, it's Tim. Thanks for joining us. I agree. We've spent the last 10 years. We've had a lot of people come on our show who said, it's just a matter of time. And so this isn't about sounding smart. In fact, I would just turn the other statement back around and just say, so if credit spreads are probably tight and don't reflect fundamentals because the Fed is there, does that mean that equity volatility is too high? If credit spreads are tight, it means that equities and credit leads the equity market. So for whatever reason, shouldn't tighter credit spreads mean that equity markets should be going higher?
Well, this is something that it's a longer conversation. Over a decade, we've seen companies use cheap credit to buy stocks, to buy basically their stocks back. And they've been doing that for years. They've had to stop doing that in 2020, or at least pull it back, because obviously a lot of companies who are in industries impacted by COVID-19 have to remain solvent. The other thing that's out there, and this is really important, there is a wall of corporate debt that's maturing in the next 5 years. And normally, without COVID, companies would just be refinancing. But the credit window, or the cost of credit, is absolutely going to go up for a lot of these companies, and in some cases will spike defaults. That's another reason why the Fed's going to be here, I think, in a big way, because it will start to trigger a massive correction if somebody doesn't help these companies borrow and refinance this debt that's coming due.
Chris, thank you. Always good to speak with you. Chris White of BondClick. Guy, it's pretty scary stuff that Chris is warning about in terms of that spike in defaults.
He's talking my language, and you know, Tim mentioned it as well. I mean, the conversation is, yeah, the Fed's there, and we mentioned, remember we talked about Dread Pirate Roberts and from The Princess Bride and how they just basically got by on reputation alone. And Chris's point is exactly that. They really haven't had to do anything in the bond market. Just knowing they're there has inflated this asset group, which is fascinating. And you know, can the Fed stay solvent? I would submit that they're insolvent, but it doesn't matter, because if you can create money out of thin air, it's a wonderful game. 29 VIX is either telling you something, or to Tim's point, is too expensive. I'm in the camp that it's trying to tell you something.
Shepard Smith here. Thanks for watching CNBC on YouTube.